Look, if you're a property investor, the most common question you're likely to be asking is, where should I buy my next investment property? In fact, who wouldn't give their second garage to know which city is going to outperform over the next decade? Well, that's the question I'm going to be asking my guest today, independent financial advisor Stuart Wemyss, Director of Prosolution Private Clients, who's going to give us an evidence-based approach. And looking at his track record, I think he's worth listening to. And even if you're not in the market for a new property at the moment, I'm sure you'll benefit from our chat. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, Stuart.
Hey, Michael. Great to be back with you again.
Well, you know what they say about forecasts. They're hard to make, especially about the future. But today I'm going to ask you for your thoughts. I'm going to ask you for your thoughts about what's going to be the strongest housing market over the next decade. But before I do, I'd like to look at your track record, considering there are so many people out there that have made, well, let's call them interesting forecasts that have been very, very wrong. On the other hand, we've been working together for a long time and I've been reading your blogs, listening to your podcast. You've got a very good track record. What were the past forecasts that you put out there that have fallen into place?
Well, Michael, as you are as well asked in the media, I guess, from time to time to make sort of forecasts about, what will property markets do in 2024 or these sorts of things. And, it's interesting discussion and I like to talk about it, but I don't think it really helps inform investment decisions.
No.
That is the short-term market sort of forecasts, what will happen over the next 2 or 3 years. Again, very interesting, but not very useful from an investment decision.
Well, the media loves it, but it's also the way the average investor thinks, and that's why they get stuck and never get past the first or second property. So we have to keep thinking about big picture and quality assets, like we said. But I do remember that the media did twist your arm and you did give some thoughts about Brisbane and Perth in the past.
Yeah, I did. So I wanted to give you that preamble just to disclaim any short term, but from a long term perspective,
and it's not a recommendation.
No, but from a long term perspective, I think markets, both share markets and property markets, are a lot easier to predict. So I'd rather ask myself over the next 10 plus years, which market do I think is going to outperform? And that's going to be an easier, quite surprisingly, or maybe it's surprising, that's an easier question to answer than which one will outperform over the next 1 or 2 years. So I hosted a investment briefing. Still got the slides I pulled them up just recently in November 18, and I suggested that the Brisbane market at that point in time, to me, exhibited the best opportunity for future returns. So that was the end of 2018. So from 2019 through to 2023, those calendar years, the Brisbane market, from a median house price perspective, has returned 10% per annum over that period of time. That means prices are up 60% since I sort of pointed out that this is. And I was a bit late to the party. I don't know why I didn't write a blog at the time. I wrote a blog, I think, in 19 or 20 about Brisbane. So I'm not sure why I was a bit late to that party. But anyway, it is what it is. Mid last year, August 23, I wrote another blog to say I think Perth is, the best market from an undervalue perspective. And since then, we all know Perth median, or most of us are aware Perth median prices are up over 20%. So again, I don't point these things out to sort of pat myself on the back, but I point them out to demonstrate the impact of mean reversion and the idea that you can apply this methodology to many different markets, geographical markets in Australia, to sort of work out where you think the returns are going to be, which is exactly what I've done on this occasion to arrive at Melbourne.
Well, for those who don't understand what the term means, I do, of course, mean reversion. What do you mean?
So it just means that periods of below average performance tend to be followed by periods of above average performance. And we know that the property market tends to move in two distinct cycles. There's a flat cycle where you'll get a period of typically 5 to 10 years of very little growth, either at inflation or even below. And then those periods are followed by a growth cycle where you'll get periods of growth of 10+%, as Brisbane has experienced. Because prior to 18, I'm not a genius on these sorts of things. Prior to 18, the previous 10 years, so really from 2007 or 8 through to 18, there was very little growth in Brisbane. So all I was doing is picking a market that really hasn't grown for 10 years, knowing that at some point it's going to enter into a new growth cycle. And the same is true for Perth. Up until the first half of last year, Perth for 15 years prior had done nothing, like terrible. So it was due for a growth cycle, but we just didn't know when that cycle was going to start.
Well, I'm going to leave a link in the show notes. Each week I enjoy getting your blogs on a Wednesday and listening to your Investopoly podcast. But in the blog, you've actually done an update on the chart you've provided over the years on how house prices have gone right back to 1980 when the REIA and Australian Bureau of Statistics figures came in. So it clearly shows how each state works in a different cycle and how every state has periods of lower growth, no growth, and then catches up. So really, the further back you go, the more statistically significant this is.
Yeah, that's right. And you can use it to your advantage, of course, because, if you're thinking about buying an investment property in a market, what would you rather do? Buy just before a growth cycle begins or buy just before a flat cycle begins? Of course, that's an obvious answer. You want the growth cycle to begin with. Now, if you hold the property for many, many decades, it doesn't really matter when you buy. The timing will be eventually diluted. But it was obviously much better if you can get a bit of growth earlier on, because you can then leverage that growth into further assets, whether that's property or other assets. So from my mind, when I'm investing, I'm always thinking about where is that market in the cycle? Am I buying at above or below intrinsic value? That obviously reduces my risk because, a market that's already cheap tends to not fall very much if the whole market falls. And then also it exposes my portfolio to potentially higher returns.
Sure. Well, we all like that free kick at the beginning with a bit of a boost. It makes us feel good as well. The problem is we've got a recency bias. The brain works in a funny way. So if you're having really good times, I think we tend to think it's going to continue on when in fact it doesn't. And each boom leads to the next period of lower growth or no growth. And similarly, each downturn leads to the next upturn. But it's sometimes hard to get into a market, Stuart, when all the media is very negative. But having said that, the question I'd like to ask you is, which is going to be the market that's going to outperform in 10 years' time when we get together in 2024? 2034.
34, that's right. I think from a dollar value perspective, Michael, it's Melbourne. So when I'm looking at dollar value perspective, what is the change in median house price between 24 and 34, as you've alluded to? From a percentage perspective, I leave room for the possibility that Perth will do just as well, possibly even slightly better than Melbourne. So I'm not sure around percentage terms, but certainly from a dollar value term, I think Melbourne will perform best, of course, because its starting median house price is a lot higher than Perth. And that's important too, by the way, because obviously we fund retirement in dollars, not in percentages. So if I'm able to invest in a property today and I'm able to accumulate $1 or $2 million of equity over the next 10 years, that's what's going to help me fund retirement, not necessarily whether I've got 10 or 11% in terms of return.
Sure. A lot of investors don't think about the return on their funds, which is an important discussion to have. But Melbourne's clearly underperformed, well, for the last couple of years. And Melbourne apartments, and we've discussed that before, have actually underperformed for, I guess, over a decade now. But there's also, that means that there's quite some negative sentiment around Melbourne property. What's been driving this?
And let's talk about that negative sentiment for a second, Michael, because when do you pick the bottom? Well, you pick the bottom probably 6 months after the negative sentiment is at its peak. If you're waiting for the sentiment to turn, you've probably missed the bottom.
You missed it.
Yeah. So I think a market tends to find its bottom when the negativity is loudest. I don't know if this very day is its loudest, but it's certainly pretty loud. And it's kind of interesting that we do have, such difference in geographical markets, because you think about the drivers around property being population growth, supply, interest rates. economic activity, you would say that, that from state to state, there isn't such a huge difference, or at least not such a difference that would drive the different results that we have today. But it shows how important sentiment really is. And so if we have a look back over the last really decade or so, in 15 and 21, Victoria tightened up tenancy laws, but it's true that other states did or made similar-ish changes. But certainly over that period of time, tenancy laws have tightened up. And now, it's very important, I think, that tenants are protected from really bad landlords, from landlords that aren't making good decisions. But like everything, laws tend to be written for the lowest common denominator. So unfortunately, even the good landlords get caught up in that. And as a result, it just creates a lot of sort of compliance costs and also deters investors, particularly seasoned investors, because they're the ones that have the juxtaposition between what it used to be like 20 years ago and what it's like today. And it's a little bit like the frog in boiling water, in warm and then boiling water. It just gradually heats and heats until a point where it becomes unpalatable. And so if you keep putting more and more requirements on existing landlords, more are just going to go, well, I've invested in property for 20 years. I've got quite a bit of equity. I don't need this hassle anymore. I'm just going to sell out. So that certainly, I think, contributed to some of the negative sentiment.
Well, the tenancy regulations, of course, are now, many landlords would say, favouring the tenants. Now, we all know that it's important to provide good accommodation, not be slum landlords. So I've got no issue with a lot of those. Recently, we've got a block of one-bedroom apartments, and I'm a pet-friendly landlord. You've got pets, I've got pets. I always allow them. But this was a one-bedroom apartment at the top of the block. Downstairs, they got courtyards, and some of them got balconies, but this particular one didn't. And the person wanted a dog. They wanted to have a dog. And as I said, we're pet friendly. We put a pet clause in. Metropolitan Property Management looks after it. But I said, hey, it's not fair to have a puppy in a one-bedroom apartment with no courtyard, no balcony, nowhere to go out and pee. And so I said no. And it's the first time I've ever said no to a request from a tenant. The tenant took us to VCAT, and the member said, I understand, but the tenant says that they're going to take the dog out to the toilet, down the stairs, out into the yard. Doesn't matter if they're at work or not. No, they're allowed to have a pet. Again, in many ways, landlords are. You mentioned extra compliance costs. I have no issue with checking the smoke alarms and all the services regularly, but there have been extra costs here, there and everywhere, haven't they, including land tax? So yes, there is a lot of negative sentiment. This is particularly for property investors, but remembering that property investors only make up about a third of the market. In general, Melbourne property prices, which are driven by homeowners, have been flat over the last couple of years too, haven't they?
Yeah, they have. There's the other factors that go into the negative sentiment, I think. For example, taxes. There's been a whole host of new taxes that the Labor government has introduced that have impacted property owners. And you could go, well, it only impacts property investors, but that's not true because, at some point you've got to try and pass on some of these costs on to the tenants. So really it impacts tenants as well. And the Parliamentary Budget Office released a report to say, Victoria is the highest tax state from a property ownership perspective. And, I think then also, if you overlay that, the concern around the Victorian government and its financial position, and then I guess people worried that, hey, maybe taxes will continue to rise because there's obviously pressure on the state's finances to do that. I think all these things contribute to negative sentiment. But I also think, there's a lot of conjecture or discussion around what caused the GFC. Now, we know what caused the GFC in the US in terms of the mortgage securities and the lending standards, but what was the final thing that broke it, right? And no one can really point to it. Some argue that there was a negative article in the New York Times the Sunday just before the Monday when it crashed, but no one can really point to it. Sometimes with negative sentiment like this, there isn't just one thing, and it's not always logical. It's not like, okay, there's land tax and this is why the investors have left. It's just it tends to be a number of different things that accumulate, and sentiment can change just as fast as it turn negative as it can turn positive. Because at some point people go, oh, yeah, that's all there, but all those things are baked into current prices. All those risks are already reflected in current prices. So I think they're the things, Michael, that I can think about or point to where what might be producing a different result in terms of growth in Melbourne versus other states. But I think it's quite subjective, and there could be a whole host of other reasons.
Well, with regard to investors, one of them is the fact that they don't feel they've got control over their valuable assets. They have less control. Having said that, they've got options now, so borderless investing is so much easier, especially with buyers agents able to help people. But having said all that, I believe that it's created a window of opportunity for Melbourne, as I know you have as well. If one has a look at how Melbourne is situated, we're actually geographically different to Sydney, which is bound by the Blue Mountains in one area, parks in another area, water in the other. Our boundaries aren't as restrictive. And recently, they've increased the boundaries of metropolitan Melbourne to include Melton, so it depends how you measure it. Melbourne's now even bigger than Sydney, the old battle there. But I think we haven't had the undersupply problems Sydney has had either.
No, that's right. And my point with respect to this was really around what is the price differential between property in blue chip locations versus property in outer areas, both in really all the eastern capital cities, so both in Brisbane and Sydney, but especially Sydney. If you look at a blue chip suburb versus a suburb 30 k's out from the CBD, you're looking at a huge price differential between a 3-bedroom home, right? Not so much in Melbourne. Partly because Melbourne can spread out to some degree. They've got more land because of those geographical constraints. I think the disparity is too small. That is that if I'm going to pay $1 million for a home in Shepparton, for example, now I know Shepparton's regional versus Melbourne, but how can a home in Shepparton cost almost $1 million and a great family home in, say, Fitzroy or Paran or something costs two and a half? That just doesn't make any sense to me. And so when investors, particularly investors that don't necessarily have a lot of experience, when investors look at historic price growth and say, oh yeah, but look what Shepparton's done over the last 10 years, or look what other areas have done over 10 years compared to blue chip areas. Blue chip areas have done nothing, but these other areas have done really well. I think it will invite them to make a mistake, that to almost conclude, hey, this area provides better future growth. Whereas we know that these blue chip areas are in high demand for a very good reason. And I just think comparatively to outer areas, Melbourne's inner city property, blue chip location property, is cheap compared to other capital cities, but also compared to the difference between blue chip and outer suburbs in other capital cities.
Now, there's lots of research houses, data houses that bring out median prices for Melbourne, median dwelling prices. One has to be a bit careful comparing like with like. So recently there's been some story about Brisbane and Adelaide dwelling prices almost equaling Melbourne dwelling prices. CoreLogic provides some really great data, but if you take dwelling prices, that includes apartments and houses, and it's very different in Adelaide, where there aren't as many dwellings that are units, or in Brisbane. So you've in many ways got to compare like with like. But if you do look at relative house values, Melbourne at the moment is so undervalued compared to not only Brisbane, but the other states, Sydney, but the other states as well. I haven't seen the differential like this for a long, long time, Stuart.
Yeah, in fact, I put a chart together which shows that really hasn't been this low really since around 06, 07, 08 for Melbourne in terms of being undervalued. Melbourne, on average, Melbourne's median house price is around about 3/4 of what Sydney's is. About 74% to be exact. At the moment, it's 54%, so it's almost half, which sort of shows either Sydney's overcooked or Melbourne's undercooked in terms of value. You compare it to Brisbane, it's not as stark. Long term, Melbourne's normally 1.3 times higher than Brisbane. At the moment, it's 1.1 times higher. And I think, that Brisbane market continues to grow. It'll almost be parity at some point, which again, if you're comparing a capital city that has circa 2 million to one that has circa 5 million people in terms of supply-demand fundamentals, that perhaps that shouldn't be the case. And then Adelaide, Adelaide and Adelaide's, despite the fact that Adelaide's had a lot of growth, it's normally close to 1.5 times. Sorry, Melbourne's house prices should be around 1.5 times. It's about 1.2 times what Adelaide is. The only one that stands out is Perth. It's almost on par with where it has been long term, which is to say that I think both Perth and Melbourne are relatively undervalued compared to the other states. So, look, when you talked about borderless investing, Michael, I guess the thing is that you're right. It's a lot easier to invest outside your domicile state these days, particularly with the internet and the ability to be able to transact with people. And we've got a lot more used to it too, thanks to COVID. So if I'm an investor, really my opportunity to invest in property is really national, to my mind, if I want to make the best investment
So it should
decision.
be.
It should be. Yeah.
Interestingly, I read an interesting study run by 2 universities about the results of people buying in their own backyard, where you think they would have an unfair advantage knowing their suburb. But when they looked at it, they found that locals who bought there actually weren't advantaged, didn't have any extra uptick or capital growth than others, maybe because they were a bit too emotional.
Yeah, that's right. You probably have your favourite suburbs and favourite streets and favourite shops, but maybe none of those things should be necessarily considered in the investment decision. If I think about 15 years ago, speaking to clients about investing outside their domicile state, I would say more than half and maybe 80% wouldn't be comfortable.
Yes.
These days, I don't think I've had any concern with that. And really, for a lot of people these days, it's, Stuart, I just want to make the best investment. You just want to have the lowest risk and highest returns. And to my mind, that's correct.
Makes
now,
sense.
Of course, there's some things that you need to consider, making sure you've got some good trusted advice, Michael, which I'm sure you can speak to. But if I'm going to make an investment, as I said, a property investment, I want to consider the full landscape, full geographical landscape. I think this sort of analysis to kind of work out where are the markets in terms of price, where is the value, where am I getting the highest value? You then got to think about, okay, if I've got a certain price point, let's call it $1 million. What's $1 million going to buy me in Melbourne? What's it going to buy me in Sydney? What's it going to buy me in Brisbane? And then you've got to consider the relative value of those investments and kind of what you're getting for your money, which is not to say, how much land, how many square meters, but really what quality are you getting for your money. And to my mind, I think depending on your budget, Melbourne can offer the best quality investments, partly because of the relative value.
Well, Melbourne offers a range of investments. So there's houses, which we've been spending a bit of time talking about. There's also townhouses, which is a preferred style of accommodation for more and more people and will continue to be so. Melbourne built a lot of villa units in the old days, more than other states where old houses were pulled down. It was more for retirees, but these are apartments with their own block of land without anybody above you or below you. And currently I'm finding one can get those virtually at land value. We've spoken about it before. The big benefit of that is if you can all get together and sell your land off to a developer, you do very nicely. But there's also apartments, and apartments really have been the poor cousin. But I know you own investment-grade apartments in Melbourne. I do. I see mine as intrinsically undervalued. Boy, have I benefited from increased rentals over the last couple of years, but that hasn't yet translated to capital growth. But only a couple of weeks ago, I was speaking with Richard Temlett, who's one of the directors of Charter Key Kramer that you'd know well, and he spent a lot of time working out, dealing with developers, what the next round of new buy-to-sell and buy-to-rent apartments are going to cost. And he felt that really the end values for them to sell and the developers to take a risk and to be able to make a profit means end values are going to have to increase closer to 40% above current market value, which means it's going to pull up established apartments, established townhouses, villa units. I think he's being a little bit, so what's the opposite of conservative? I'm having a mental blank at the moment.
Ambitious.
That's a better word, thinking that that's going to happen straight in the next year or so. I don't think that's the case. I think it's going to take a while for the cycle to move on. So clients we're advising to buy in Melbourne at the moment, we're saying, hey, don't be surprised if at the end of this year, Perth property values will do better than Melbourne. Brisbane property values will have grown more than Melbourne. I'm giving you that caveat now, but if you've got a 10-year time frame, then Melbourne's going to outperform. And again, there's not a Melbourne market. So an underperforming property in Melbourne won't perform as well as a regional property that's a better class property. But I think you and I keep talking about the concept of buying quality assets. So Melbourne has got still a range of quality assets that you can buy below the cost at what it cost you 2 years ago when, Stuart, it's now 2 years that interest rates went up. In May 2024, they started going up. Boy, that's an amazing thought. Property values went down. They've gone up again a little bit, but Melbourne still hasn't reached its previous peak.
I agree. I'd echo that, Michael. I reckon somewhere between you can buy a property in Melbourne today and possibly in the next 1 to 3 years, you might not be better off for making that decision. So I think it's entirely possible in 3 years' time, maybe prices haven't moved that much. I think that's probably towards the upper end of the range, but I don't think they're necessarily going to change tomorrow. But you just don't know when they're going to change, firstly. And I still think it's the best 10-year decision. So starting today, thinking about and averaging that growth over the next 10 years, I still think it is the best 10-year decision from a dollar value perspective. The thing we've got to think about, though, and I know because I've said this many times over the last couple of decades, I know most people aren't going to listen or take action to this observation or sentence. But the thing to think about is this market today is a lot easier to operate in than the market that will exist after sentiment has changed.
Yes.
Once the general consensus is, oh, Melbourne's bottomed out, it's good value, that's not really the market you want to try and operate in from an acquisition perspective, because that's when prices are moving fast. There's a lot of demand. You've got to then try and ascertain what is this property really worth in today's market today, because in 2 weeks' time, that number might be different. Could it be different because it is moving fast? Whereas today, your main challenge is finding a good asset. There's a bit of stock on the market, but not necessarily great quality assets that are available. So, but there's no rush, you can, if it takes you 6 months to find the perfect asset, so be it, because, it's unlikely prices are going to move.
If you're waiting 6 months, you're probably being a little bit too fussy unless it's for your own home. As an investor, yes, you've got to look at all the aspects and get a quality asset, but there are still things around. Now, people are saying, oh, yeah, but when the market bottoms, vendors, sellers are going to come back in the market and put their houses on the market. They've got to remember that most vendors are also buyers. Buyers are sellers and sellers are buyers, because we think like investors, but most people are going to say, oh, time to upgrade my home or right-size my home. There's going to be a lot more competition when money flows more freely, Stuart.
Yeah, that's right. Again, it's easy for us to be able to say because we've been in the market for a long time. We're investors ourselves. We talk to investors all the time. So we can say it with a level of confidence, but I appreciate, for first-time investors or investors don't have as much experience, buying in Melbourne today feels risky. You're buying something that's completely unpopular that could fall further. I don't think it's going to fall. If it falls, it's going to be very minimal, but appreciate that it's kind of against conventional wisdom.
And remember that Melbourne is going to get more than its share of immigrants, and most of those are knowledge workers, so they're going to have higher incomes and be able to afford to buy properties. They're also going to be tenants. In fact, a recent chart from PropTrack from realestate.com showed that there's more high income earners that are now tenants, Stuart, for various reasons. So people don't only rent because they're poor and can't afford to get into the housing market. Many do it for lifestyle reasons as well. So in summary, there's minimal downside. There's great upside in Melbourne, but again, it all has to do with quality asset selection, because there's always going to be dud properties in these markets.
Asset selection is key in any market. So, quality is the absolute fundamental key. Of course, as I said, if you can buy into a market just before a growth cycle, that's great from an investment returns perspective. But quality trumps timing and quality trumps quantity, like in terms of price point as well. So quality is absolutely key. So whilst we think, I think Melbourne over the next 10 years will outperform, be the best performer from a dollar value perspective. That's not to say every single property in Melbourne is going to do that. And in fact, as we've spoken about in this podcast many times, there's a few headwinds for property investors in terms of, stagnant borrowing capacities and these sorts of things. So you really, asset selection, I think in the future, in terms of future returns, is more critical today than it's ever been over the past few decades.
Well, that allows you to outperform the averages, and that's one of the great things I like about property. Now, I'm going to leave a link to your great blog, and I'm also going to suggest people who are listening to this podcast subscribe to your Investopoly podcast, wherever they're listening to this. Now, I know we talk about similar things, but that's okay. It's just a different perspective. By now, being a regular, people would or should know you, but we have lots of new listeners. So maybe you could just explain how you and the team at Prosolution Private clients help property investors.
Well, we're a holistic business, Michael, which means we offer mortgage broking, tax and accounting and financial planning, but really building wealth is at the heart of everything we do. So the best analogy is like I can go to a builder and say, build me a 3-bedroom family home, and it'll have 3 bedrooms, a lounge room, a kitchen, etc. Or alternatively, I can go to an architect and say, design me a 3-bedroom home that I can build. And that home will be built to what I need for my family and my goals and my so forth. And that's the same. I can go off to my accountant and say, help me save tax. But the strategy gives us context for those decisions. Because a lot of financial decisions are multifaceted, I think that context allows us to harness the most amount of value.
Oh, it definitely does. I haven't heard that architect analogy before, but it really does make a lot of sense to go to a specialist in these areas. Of course, I'll leave a link to ProSolutions in the show notes as well. Stuart, thanks for your chat. Look forward to catching up with you next month.
Thanks, Michael. It's been a pleasure.
I enjoy my regular monthly chats with Stuart Wemyss, who brings great advice, evidence and factual-based advice to our housing markets. If you don't currently subscribe to this show, why not stop for a sec and on whatever podcast player you're watching this or on YouTube, just click the subscribe or follow button so twice a week you get information from my guests and me. I guess the other thing you would have gleaned from our discussion is that over the long term, our housing markets are going to keep performing strongly. We're at the beginning, still the early stage of a new upturn stage of the cycle, which started in early 2023. But there's no doubt that all the economic, political and financial challenges the world's throwing at us is worrying many would-be home buyers and property investors. But how long are you prepared to wait? Because strategic investors aren't worried about where interest rates or the economy is going to be in 3 or 6 months' time. They're encouraged by where the property markets will be in 5 or 10 years' time. So are you interested in getting involved in property, maybe as an investment or a new home, before FOMO drives the herd back into the market when eventually interest rates start falling and all the news is positive? If you are, why not have a chat with one of the wealth strategists at Metropole? It's obligation-free, and we're much more than buyer's agents. By the way, we've got no properties for sale, but we help our clients safely create intergenerational wealth through strategic property and wealth advice. And while we're big enough to tip the scales in your favour, we're small enough to care. So go to metropole.com.au, there's a link in the show notes, and organise an obligation-free chat with one of the wealth strategists at Metropole to discuss your options.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share with you a framework that may help you avoid bad outcomes. It's about the boiling frog syndrome. Look, you've probably heard about it. If a frog's placed in boiling water, it'll instinctively jump out to avoid being killed. But if a frog is placed in warm water that's slowly brought to the boil, it may not notice the creeping, subtle change in temperature until it's too late. Now, the boiling frog analogy brings to life a harsh reality. The most dangerous habits, behaviours and beliefs are the ones that you slip into slowly, day after day, without even realising the damage they're doing to your life. We think that the catastrophic outcomes can be avoided by simply avoiding significant mistakes, when in reality, some catastrophic outcomes are often simply the macro results of thousands of micro mistakes. The micro mistakes can take a variety of forms. The diet and exercise slip up when you don't feel motivated, the tiny white lie you tell to cover up a mistake, the lack of appreciation voiced to a person you love. I'm not just talking about money, I'm talking about your life in general here. I mean, obviously the financial little slip-ups also add up, but in each case, small things feel small enough to ignore in the moment, but they're silently, subtly compounding to become something big in the future. So my suggestion for you in this mindset message today is perform an honest assessment of your own life. Firstly, where are you falling victim to the boiling frog syndrome? Secondly, where are you allowing micro mistakes to compound quietly in the background of your life? And then what changes can you make today to stop their future impact? If you address these questions and avoid bad outcomes, that's going to improve your life. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?